Okay, so we have our income statement done. Now we're ready to move on to our cash flows and our balance sheet. So I have a tab set up here for cash flows. It's empty right now, but we'll be filling that in pretty quickly here. And over here I have my balance sheet. So this balance sheet represents the year ended the same time period as my income statement was for. So in other words, the income statement was for the year of 2009, ending on December 31st. This balance sheet is as of December 31st, 2009. And this balance sheet is actual data that I have received from historical, from my company. They printed it out for me, gave it to me, whatever the situation you have. And I want to forecast this out over the next 3 years. So what I'm going to need to do is get some headers in here for column C, D, and E, which would be December 31st, 2010, 11, and 12. I'm going to grab those from over here so I don't have to retype them. And I'm going to go to my balance sheet and paste those in. Okay, the rest of this balance sheet we're going to be filling in as a result of the things that we put on our cash flow statement, on our cash flow worksheet. So the only thing I really need to do here is pull my totals across so that I can always monitor that I'm staying in balance with my balance sheet. Okay, because if our balance sheet gets out of balance, then it gets to be a real problem to go back and find it. It takes quite a bit of searching sometimes once your balance sheet gets out of balance. So we want to make sure that we're always in balance here. And our balance sheet for the next year, for 2010, for example, is going to be primarily based on our balance sheet from 2009, plus and minus any changes. So what I'm going to do, just as a starting point, all these formulas will change in them as we go through, but I'm just going to say what's the balance from the prior year, and I'm just going to bring that in here, okay? And so that way I have a starting point to see, okay, am I still in balance? Now, of course, I'm in balance because it's just the same exact number. So you're going to watch as I go through. I'm going to be changing each of these formulas, but while I do it, I want to make sure I stay in balance. Okay, so what I'm going to do now is I'm going to go to the View tab, and I'm going to say New Window, Arrange All, and Vertical, so I can see two pages at the same time. On the left side, here's my cash flow. On the right side is my balance sheet. And on my cash flow, I'm going to want to put some headers in here, so I'm going to grab my forecast, and I'm going to put that here into column C. The reason I put it into column C, D, and E instead of B, C, and D is because I want to keep my columns consistent. In other words, here, column C is 2010. Here, column C is 2010. Makes it a lot easier as you're starting to work through, especially if you were working on a forecast that was a lot larger than just 3 periods. I'm going to go ahead and hide column B because that's not going to even be something I want to see anymore. And now I'm ready to start building my cash flows. Okay, our cash flow worksheet, we're going to start with net income. In other words, we're going to do the indirect method for our operating. And what that means is we start with net income, kind of like pretending our net income is our cash flow, and then we're going to make adjustments to it. Those adjustments are going to be the same thing that have an impact on our balance sheet, as you're going to see as we go through. So I'm going to leave a whole bunch of blank lines here, knowing that I'm going to fill those in a few minutes, but I want to kind of build the top and the bottom of my cash flow, so that way as I fill things in, it can roll over to my balance sheet and keep my balance sheet in balance. So down here I'm going to say, okay, here's my change to cash, which is going to be equal sum, and it's going to be everything that I'm going to be putting in up here above. Okay, and then beginning cash and ending cash. So beginning cash is going to come from my prior balance sheet. So there's a formula that brings that in. And my ending cash is going to be my beginning cash plus my change in cash. Okay? And now I can come over to my balance sheet, and instead of getting my cash balance from the prior year, which obviously is wrong, I'm going to get my cash balance from the ending cash on my statement of cash flows. Okay? Now that I've made one change on my balance sheet here, I want to check, and yep, I'm still in balance, so I can continue on. We'll worry about formatting on our cash flow once we're all done. We'll put some formulas in here, or some formatting in here, and make it look a little bit better. Okay, on our cash flow, the next thing that we want to do is add to our net income our depreciation. So I'm going to go add depreciation. Okay, and now we can start pulling some formulas in here. My net income is going to come from my income statement. Let's get the right one. And the depreciation is also going to come from my income statement. Why are we adding back depreciation? Here's why. Remember, we're saying let's pretend like this net income number is our cash flow. But if you think about it, think back to your financial accounting. What's the journal entry for depreciation? Debit depreciation expense, credit accumulated depreciation. In other words, there's no cash. So we need to add that back. In other words, this depreciation reduced our net income, but it did not reduce our cash. So we want to add it back. Okay? Now we want to start thinking about our other current assets here, our accounts receivable, our prepaid expenses, and our inventory. So what I'm going to do here is I'm going to have a spot that says if it's a negative number, it's an increase, or if it's a positive number, it's a decrease in these accounts. Now that might seem a little counterintuitive to make a negative number an increase and a positive number a decrease, but the reason we're doing that is because everything on this cash flow spreadsheet is supposed to be thinking about it in terms of cash. And if we want to increase our accounts receivable balance, that means that we're making sales that we're not yet collecting, which is sort of like a decrease to our cash. So in other words, I'm going to start selling this fruit. Maybe I expect my accounts receivable is going to go up by $5,000 in the first year, and by $7,500, and then by $10,000. Okay, so let's make those negative so that they can be increases. Okay, so this negative number represents a decrease to my cash, but an increase to my accounts receivable. So over here, I want to go to my accounts receivable, and I want to modify this formula to not just be looking at the prior year balance, but also I want to take into account this cash flow item. Okay. Now you can see we're out of balance here. And we're out of balance because we've added two things to our cash flow that we haven't taken into account on our balance sheet. So why don't we do that now so that we can be back into balance, so that way we're always able to make sure that we haven't messed something up. So let's go back here and look at our net income. How does net income eventually make its way to the balance sheet? Well, net income makes its way to the balance sheet by increasing retained earnings. Remember, on your statement of retained earnings, beginning retained earnings plus net income minus dividends. So what I want to do here for my retained earnings balance is take the prior balance, and then I'm going to add to it my net income. So plus net income. Okay. And we also have this depreciation. Remember how depreciation affects our balance sheet? It has the accumulated depreciation, which reduces our net equipment. So here, under the property, plant, and equipment, not only do I want to grab the prior balance, but I also want to subtract my depreciation for the time period. And now you can see, once again, I'm back in balance. Okay? So you can see that if you don't stay in balance as you go, then you have to go back and try to figure out what you did. So it's a lot easier just to stay in balance as we go. So that's what we're going to do from here forward. Okay, so let's assume that my prepaid expenses, my business is going to grow a little, but I don't expect my prepaids to grow very much. So maybe I'm going to put $100 each year as an increase. Okay, I'm doing it again. Let's make those negative hundreds. Okay, and so over here on my balance sheet, you'll see that because I made a change here, I'm now out of balance, right? I'm out of balance by that $100. So what I want to do is go to my prepaids, and I want to subtract the adjustment here, and that pulls us back into balance. Now I'm in balance. Okay.